Hello and welcome to the paid weekly recap for the week ending January 30th, 2026. I'm Keith Harwood, CIO of Yellow Tunnel, and also pictured as Vlad Karpel, the CEO and founder of Yellow Tunnel and the creator of the artificial intelligence behind the paid system. Normal disclosures before we get started: options involve substantial risk and are not suitable for all investors. Yellow Tunnel and myself are not investment advisors and not registered with the SEC nor FINRA. The information in this presentation is for education and information purposes only and should not be considered trading advice. And finally, myself and/or the team at Yellow Tunnel may have a financial interest in the securities presented and the trade ideas. I also urge you to read characteristics and risks of standardized options available at the link highlighted here. If you need more time with the disclosures, please go ahead and pause the video here. Otherwise, we will get into the recap for this past week. So first things first, we have the 10-year yield, which has been generally stable after breaking out above 4.2%. Pushed through about 2 weeks ago, has been holding above 4.2 previous resistance. New resistance appears to be forming at either 4.3 or 4.35%, but right now we're stuck around 4.25. Nothing major shifting here. While there was a major shift, it seems, with Warsh getting the nomination for Fed president. That shifted precious metals. It didn't have an impact on 10-year yield. So for this week, we had the market in a very choppy mode. Microsoft earnings really started to put some pressure, as well as ServiceNow. ServiceNow being that it impacts expectations of AI growth, and Microsoft being a company that is very focused on AI. So on Thursday, earnings drove this market to a potential for a break. By the end of the day, we bounced back. Friday, a bit of weakness, but overall an inside day, not the full weakness that we saw on Thursday, and an overall okay market. S&P looks to continue to repeat the process. Dip, but find buyers. This week will be telling, because if we can get below Thursday's low, we may be in for some greater downside threats here. But for this move on Thursday, it was a higher low after making a new all-time high. It's a pattern we've seen over and over. Make a new all-time high, maybe push up for another day or two, and then have a few days down, and then make a new all-time high, and then stabilize around there, and then pull back down on January 20th. And now we recover and make a new all-time high and dip. And each time the dip has been to a higher low, and then followed by, again, a new all-time high. At some point, that pattern will break. Either we will not dip, or the dip will turn into something worse. But for now, continuing to trade these rangy moves to the upside are working. For the NASDAQ, a bit of weakness as well, touched the 50-day moving average. And given that a lot of this concern from the earnings side is on the tech side, it's natural to see some outflows out of tech. So Friday was a little weaker relative to the broad market, but overall still holding above the Thursday low and still holding above the January 20th low. We did not make a new all-time high on Wednesday, but overall tech looks okay, much more stable, less bullish on the broad longer term, as we failed to break out from resistance. But overall, it's a stable, slightly bullish market. And then we have small caps, which were the bull market, made a new high on January 22nd, appeared to be ready to push a continued bull market here with a number of different subsectors driving that. You know, we had good healthcare, we had some good financials at times, we have good energies right now, but then we've seen some of that rotation. Financials a little bit weak on earnings. Healthcare hit, particularly United Healthcare, Humana, and CVS on Tuesday due to Medicare reimbursement rates. And so small caps right now are still in that pullback. We made a lower low on Friday than we had on Thursday. Money flow is still determining which sectors need to have the dominant investment thesis right now. And while February can be a bullish start to the month, we do have non-farm payrolls on Friday, so we'll see if that has an impact, positive or negative. And we do have these unknowns. Now, speaking of that healthcare side of things, first we have the VIX, which did make a push towards 20 and then pulled back. Right now, it's still a little bit elevated at 17.5, and I expect to see this drop back down into the 14s if we do see a bull market take hold. Right now, the market is still hedging. So there's been a lot of put activity, a lot of put buyers on these dips. Now, speaking of the healthcare names again, pulling back in here, for paid for this week, we did have one signal and it was in CVS. So CVS was showing some bullish momentum, bullish money flow heading into the week's Medicare announcement. And then on that announcement had a big drop. Now, early in the day, looked like support was starting to hold around 74, and so we added the put credit spread, the 74.73 for Friday. Ultimately, CVS did fall further, but it immediately started bouncing back on Tuesday and then stabilized. So it was a bit of an oversized correction as market participants were looking to reduce that newly built long. But being that it was something that people were looking to buy into, we saw the bounce back. So an entry on Tuesday on the open, price was 75.40. By the close on Friday, it was 74.52, 1.2% down over that 3-4 day window. The 74.73 put credit spread ended up worth nothing. Idea is to generally close these positions when they're close to being in the money on expiration. 30-cent credit initially, a 2-cent debit to exit. So collecting 28 cents with initial 70 cents of risk. The difference in the put spread is $1. 30-cent credit means there was 70 cents max risk, making 28 cents is a 40% profit. So in spite of a little bit of weakness and then consolidation by the stock, the put credit spread achieved near max profit. All in all, a good implementation of the AI generated signal where it was clear that there should be some dip buyers and that they may get an oversized correction initially with a bounce back. And that was what the expectation was here. And then that correction did come in further after the initial entry, but the bounce back was there. So the put credit spread worked out well. Chalk that up as a win in the paid column or paid in the win column. And we'll take it for that. We'll look for new opportunities this week, sometimes a little bit dicey with non-farm payrolls, but depending upon the sectors that we're seeing out of the AI signals, we'll look for new opportunities this week. So keep an eye on your inbox. Also, keep an eye on the live trading room. Continuing to see strong performance, and hope you guys all can join us and ask questions. If you have questions about the stocks and the strategies that we're looking at for paid or just general market conditions, feel free to jump in with us. Morning bell from 9:15 till 10:15, 10:30 Eastern, closing bell from 3 to 4 Eastern. Vlad and I will be there at differing times. Happy to address how we are approaching the markets and managing and navigating some of this chop. And if you can't join us on the live trading room, or if you have a question outside of the live trading room, you can always email us as well. I'm Keith at yellowtunnel.com, and Vlad is Vlad at yellowtunnel.com. Thanks again, everyone, and looking forward to another positive week. We'll see how things go.